Dear student, welcome to the capital market class. This is our new edition that every lecture will be recorded for the capital market. Now, please remember, this is not replacing our regular lecture. After our regular lecture, I'm going to upload a video file for the lecture to every class. Now, today we'll be talking about the equity market, which is chapter number 10 in capital market. Introduction. When we're talking about the equity market, the first thing is coming to our mind is the share market. Now, the share market is a formal exchange that facilitates the issue of buying, selling, and issuing the ordinary equity. Now, only the public listed corporation which are listed to the stock exchange can sell or buy their equity through the stock exchange, and the stock exchange having also a physical location. Now, what types of shares are listed to the stock exchange? Now, generally we know only the ordinary equity are listed to the stock exchange. However, there are some other types of equity. For example, the preference share can be listed to the stock exchange as well. Now, in the stock exchange, it's not just the equity instrument are listed, but also some of the debt instruments such as the bond could be subsequently listed to the stock exchange. However, as this lecture is about the equity, so we'll be talking about the equity market. Now, the principal forms of equity issued by a corporation is the ordinary share. So what are the basic characteristics of the ordinary share? First, the ordinary share has the basic ownership claim of the corporation. So the ordinary shareholders, they are the owner of the corporation. Second, the shareholders they share directly the corporation's profit and losses. So they have a claim of profit and losses of the organization. So the way the shareholder will be able or will be receiving the profit through the dividend of the corporation, the same way they had to face the losses. Third, if the company is going for the liquidation, the ordinary shareholder will receive their money at last. However, this has to be noted that as at the time of the liquidation, the credit holder will receive their money first. After the credit holder, this is the hybrid shareholder or the hybrid instrument holder will receive their money at second. So the shareholder will receive their money at last. So a lot of money will be losing through the process, and if there's anything left, the shareholder will receive that. Dividend. Now, dividend entitlement is one of the biggest claim of the shareholder. The shareholder will receive the dividend if the company declared the dividend. However, this has to be noted that the dividend entitlement are not a liability for the corporation until it has been declared. So the ordinary shareholder or the equity holder will have the entitlement of the dividend. As we know, dividend plays a very important role for the corporation. How we are going to value a corporation's equity? Now, there are different models, and one of the model is the dividend discount model. So it plays a significant role for valuing the equity. In Australia, the government has introduced the dividend imputation process. Now, the dividend imputation process encourages investment in the stock exchange. How it is encouraging the investment? Because the dividend imputation process is helping the individual to avoid the double taxation system, so it increase investment or encourage investment in the share market. However, not all the countries having the dividend imputation process. therefore it certainly benefit the ordinary shareholders. Now we need to also talk about the nature of the corporation. What are the advantages of the corporation? The first advantage of the corporation is it obtains a large amount of finance for a relatively cheap cost. Because the corporation is issuing a large amount of equity in the share market. For example, a corporation might issue millions of equities. Think about our large banks such as Westpac, ANZ, or NAB, Commonwealth banks. So these banks issue millions of equity in the stock market, and they can raise the fund relatively at a cheaper cost. Second, the equity helps the investor to diversify their portfolio. Through issuing equity in the share market, it encourages investment in the ordinary equity, and it also encourages diversification of the investor's portfolio. Third is specialized management can be chosen. Now, this is one of the biggest advantages of the large scale of operation. Because the corporation has a separate entity, so they can select a specialized management which will be experienced in their own field. And they can guide the corporation in a right way and show them the good way or the good path of the success of the corporation. Fourth is the perpetual succession. The corporate entity has its own name. So the corporate form will not be affected by the change of the management or the ownership or the death of a large shareholder. So the corporation form is also helps or it's suited for the large scale of operation. Now these are the advantages of the corporations. However, since the corporation having a lot of advantages, there are some disadvantages as well. The primary disadvantages arises due to the separation of the ownership and control, which can also be treated as the agency problem. Now, what is an agency problem? So the agency problem is when the management might not have the strong incentive to act the interest of the owner or the shareholder to maximize the shareholder value. The management might want to increase the shareholder's value through their own channel, which might not be always in the favor of the shareholders. So, if the management having their own incentives or own way of increasing their own value of the corporation value, what are the options of the shareholders? Now, the first option is the dismissal from the board at the AGM by the shareholders. Now, this is a difficult situation because the shareholders need the majority shareholders vote in order to dismiss the board or the executive management. So what is the option? So the second option would be to sell the shares in the corporation. Now when the shareholders selling the shares in the corporation in the market, if a large scale shareholder or large shareholder who has a significant number of shares of the corporation selling a share in the market, that gives a negative signal in the market, and this negative signal will tell the market that there is something wrong of the organization and the shareholders are not very happy with the executive management. So that might force the executive management to change their direction. Third is threat of takeover, bid, or loss of employment. Now this is not always the case, so this is one of the extreme options the shareholders might have. Fourth is the use of performance incentives like the share options. Now this is probably one of the most exercisable option for the shareholders. Often the executive management, they receive the share option, which allows them to receive additional remuneration. Now the executive management will always want to increase the value of the corporation when they have the share options, because they know if the share price is going up, they will have some share options, which will certainly help them to get some additional profit. Now, when we're talking about the ordinary shareholder, we also need to think about what are the other forms of equities. Now, the preference share, they represent an ownership interest of a corporation. However, at the time of the liquidation, the preference shareholder will rank above the ordinary shareholder. And additionally, the preference share normally have a fixed dividend, and in respect of example corporate bond. Please note that the preference shares, these are the hybrid instrument. Also, what is a hybrid instrument? A hybrid instrument is an instrument which has the characteristics of debt and equity. For example, the preference share, it has the characteristics of equity, but it has some characteristics of debt as well. For example, preference share, the holders, they will not have the voting right. There could be a redeemable preference share, and preference share also will have the promised dividend. So these characteristics of the preference share allows to differentiate the preference share from the ordinary equity. Therefore, preference share is also called a hybrid instrument because it has some characteristics of debt instrument. So what are the different types of preference share we can see in the market? Now, there are 4 different types of preference shares. One is the cumulative preference share or non-cumulative preference share. So the cumulative preference shares are those shares that if the dividend has not been paid in one period, then it will be paid in the second period, and in the second period, and they'll pay the second period for the first and second period, both the dividend. If it's a non-cumulative preference share, if they miss one dividend, then it will not be paid in the second period. The second types of the preference share is called the redeemable or non-redeemable preference share. So if it's redeemable, it can be redeemed, you can call back. If it's non-redeemable, it cannot be. The third type of preference share is called the convertible or non-convertible. If it is a convertible preference share, it can be converted to an ordinary equity. However, there will be a fixed conversion price. If it's a non-convertible preference share, it cannot be converted to an ordinary equity. However, the most interesting types of preference share could be the participating or non-participating preference share. The participating preference share, they can participate on the company's profit if the company profit exceeds certain limits. So they can participate on certain percentage of the profit. However, most of the cases, preference shares are non-participating. So the preference share can be issued in different ranks and types by the organization. Convertible equities. So the convertible preference share can be converted in ordinary shares as predetermined ratios. So the convertible equity also includes the preference share and other types of convertible security as well. For example, the convertible note. However, there are some differences between the convertible preference share and convertible notes. Initially, the convertible preference share, it is an ordinary equity, but it has some debt characteristics. However, it has more equity characteristics than the debt characteristics. However, on the other hand, the convertible note, it has more debt characteristics than the equity characteristics. However, when we're talking about the primary market of the equity, so we need to understand that the primary market equity includes the initial public offering. So the initial public offering is when the securities are issued in the market for the first time. So the new issue of security are sold in the primary market. The seller received the proceed of the IPOs and investor receive the shares. After the IPO, shares changes hand on the secondary market. So in the secondary market, only the share changes hand rather than issuing a new equity. So we need to think about what is an initial public offering. So the initial public offering, when the company issues new share to the market. However, there is a nice and interesting video in the ASX website about the initial public offering. So I would like you to watch the video first before we proceed. As we have seen the video of initial public offering, so the new issues must meet the ASX listing requirement. So the promoter is appoint an advisor who might be a stockbroker, a merchant bank, or another specialist, and probably an underwriter. So the advisor will advise on the structure of the issue, the pricing of the issue, the timing, the marketing, and the allocation of the issue. So the structure of the issue might be how many number of shares will be issued in the market. The pricing could be what could be the unit price in the market. Timing, what is the best time of issuing the share in the market. So these are important factors. So at the initial public offering, the advisor will give advice on these types of issues to the promoter, underwriter. So the duty of underwriter is to ensure that the company raise full amount of issues without any difficulties. So the underwriters also assist that if there's any unsold amount of shares in the market, the underwriter will purchase the unsold amount of share. And the underwriter will also assist the promoter to submit the prospectus to the ASIC, the stock exchange. Now when we're talking about the stock exchange facilitate the issue of buying and selling of equity security. However, there are different types of role of the stock exchange. The first role is the primary market role. Second is the secondary role. Third is the derivative market role. Fourth is the interest rate role. Fifth is the trading and settlement role. Sixth is the information role. And seventh and the last one is the regulatory role. So when we're talking about the share ownership in Australia, you'll be amazed to know that Australia has one of the highest proportion of share ownership in the world. In 2008, Australians received about 53% of their wealth. Australia invested about 53% of their wealth in shares. However, during the global financial crisis, the share ownership has dropped to 43%, which certainly increased again after the GFC. So, stock exchange ASX as a glance. So the number of country listed stocks in the ASX is about 2,192. Domestic market capitalization of ASX is 1,665 trillion. Average daily turnover is 4.685 billion. Domestic market liquidity is about 93%, and Australia is having one of the top 15 listed stock exchange group. A short seller. So the investor who think that the share price will fall may sell the shares without owning them. So how it happens? So when we're talking about the short sell, so short sell is a person or is an investor who want to borrow some shares from a corporation without owning them. So he's borrowed the shares without owning the shares and assuming that the share price will drop. So he will borrow the shares, sell it to the market at higher price, and when the price of the share will drop, he will sell the shares and he will buy the shares from the market and he will return the shares to the corporation. Now there is a working example, so I would like you to read this working example. The shares in C and Company currently trade at $10 per share. A short seller borrows 100 shares of C and Company and immediately sells them for a total of $1,000. Subsequently, the price of the shares falls to $8 per share. Short seller now buys 100 shares of C and Company for $800. Short sellers return the shares to the lender, who must accept the return of same number of shares as was lent, despite of the fact that the market value of the share has been decreased. Short seller retain as profit the $200 differences, so this is his profit. However, he also need to pay the fees to the corporation. Now this is his profit. Now the primary market role of the stock exchange, as we discussed before, is promote the IPOs. Now in this chart it explains in detail how it happens. So if you look at the chart here first, so the advisors, underwriters or the sub-underwriters, they help the promoter to promote IPOs through the stock exchange of the, so this goes to the corporation and help to promote the shares. And then they also find the individual institution and other institution would like to buy the shares. So these are the flow of the ownership rights. So the flow of the ownership right also helps them to flow of fund. So the flow of fund will go to the broker, and the broker will send the fund to the stock exchange and the corporation. Now this is the primary market role of the stock exchange. Now we need to understand that when we're talking about the share market investment, the factor encourages the investment in the securities includes three things. One, the depth of the market, which is the overall capitalization of the corporation listed to the stock exchange. Second, liquidity of the market. So if the liquidity of the market is higher, so then it means there will be higher number of trading will be going on. So the volume of trading relative to the size of the market is called the liquidity. Third, efficiency of the market. Speed and efficiency with which the new information is reflected on the current share price. Now, efficiency is very, very important, because an efficient market will help the most efficient user of the fund to save the maximum amount. However, if the market is not efficient, the most corrupt user will have the opportunity to save more and more fund. And now, the trading and settlement role of the stock exchange. Now, the share traded using the electronic based trading system in the ASX, which is also called the Stock Exchange Automated Trading System, which is also called the SIT system. So the SIT system helps the client order to be executed by the computer from the broker's office. It also helps the orders to be executed in order to time of the receive and the sellers and buyers price. So SIT system has been improved. The speed and efficiency of the trade processing and the settlement. Now the SIT system is also provide us the efficiency. It's more informative, it's less hassle, easy to understand and prompt service, because this is an automated trading system, and this is very efficient, and this system is helping to make the system more effective, more efficient and informative for the buyers and the sellers of the stock exchange. In the trading and settlement role, the ASX also used the Chase system, which is also called the Clearinghouse Electronic Sub-Register System. So the share ownership and settlement performed electronically in Australia, and settlement of the transaction, it takes only 3+ business days, which is also called T plus 3 days. Now, if you need more information about the Chase system of the ASX, you can click in the frequently asked question, and it will take you to the stock exchange about the frequently asked questions. So if I click here, it will take you to the stock exchange. Now the next part is the information role of the stock exchange. As we know, the information efficiency is absolutely important for any corporation or for any market. And information efficiency also indicates that the current share price should reflect all information available in the market. And ASX has critical role in facilitating the flow of information to the market. So the information role also include that the listing rules of the ASX, which listed entity must comply. Some examples of the information disclosures include the changes of the forecasted profitability or expectation, appointment of the liquidator, declaration of the dividend or the distribution, notice of takeover bid, disclosure of the director interest, asset, contract and other beneficial interest. Now this part is discussing about the preference share valuation. So preference shares are like preference shares are not like the ordinary equity. They receive a promised dividend from the corporation. Therefore, the valuation of the preference share are different than the ordinary share. So the preference share, they are like so the preference share they are like so the preference shares are not like the ordinary share. They receive the promised dividend regularly. So the preference share is entitled to receive the regular dividend from the corporation, and it is actually like a perpetuity. So therefore the valuation of the preference share are different than the ordinary share. So the valuation of the preference share would be PO equivalent, which is PO is the price of a preference share divided by D divided by equal to D divided by R. D is the dividend, which is the same dividend they will be receiving forever or for a long time, divided by the rate of return. So this is also a perpetuity formula that can be used to value the preference share. However, the valuation of ordinary share are different than the preference share, because the valuation of the ordinary share depends on the dividend entitlement, and the dividend of the ordinary share are not the same dividend forever. So the dividend are expected to grow at the same time rate forever. Then there will be different valuation formula. Now in this formula, what we can see here, PO is equal to D1 divided by R minus G. So D1 is basically dividend of period 1, and the dividend of period 1 is equivalent D multiplied by 1 plus G. 1 plus G is the growth rate. Now what is the growth? Now before going to the growth rate, we need to understand what is called the zero growth. The share having a constant dividend and no growth at all is called the dividend with the zero growth. So the value of the share is then the same as the value of the ordinary perpetuity. So for example, if we look at it in here, then D1 is equivalent D2, equivalent D3, equivalent D4. So if there's no growth, so DO, which is the dividend of period 0, will be equivalent to D1, and D1 will be equivalent to D2, and D2 will be equivalent to D3 and D4. So in that case, we will using the perpetuity formula. So the price of the share which is having a zero growth will be dividend divided by the R. However, when the dividend is constantly growing, then the formula will be different. So in that case, the dividend of period 1, which is D1, will be equivalent to DO1 multiply 1 plus G, so which is the dividend growth model. So the G is the growth. In the same way, D2 will be D1, which is this D1, the value of D1 multiply 1 plus G. G is the growth rate. So in that way, the formula will be the price of a share which is having constant growth will be equivalent to D1 divided by R minus G. And D1 is equivalent to DO multiplied 1 plus G. For example, the company XYZ just paid a dividend of 15 cents per share, which is expected to grow at 15% per annum. What price should you pay for the share if the required rate of return on the investment is 10%? So in this example, the company XYZ just paid 15 cents per share dividend. It is expected to grow at 5% per annum, and the required rate of return is 10%. So if we put all these things in the formula, so D0 is 15 cents multiplied by 1 plus G is the growth, which is 0.05, divided by R. R is the required rate of return, which is 0.10, minus G. G is the growth, which is 0.05. So this way we'll find out the price of this ordinary share is $3.15. Non-constant growth. However, the share will not have always the super growth or always not have the same growth forever. So sometimes the share market can have a strong growth for a small period of time and then will have a constant growth. So in that case, we'll use a non-constant growth formula. So this will allow a super normal growth rate over a finite length of time, and then after that we'll have a constant growth. Let's look at the working example. For example, a company just had paid a dividend of 15 cents per share, and the dividend is expected to grow at a rate of 20% per annum for next 3 years, and at the rate of 5% per annum forever after that. Assuming a required rate of return is 10%, calculate the current market price of the share. So in this example, we find out that the company has just been paid 15 cents per share. The dividend is expected to grow at the rate of 20% per annum for 3 years. So first 3 years we'll have 20% growth, which is a super growth rate. And after that, after the 3 years, the rate will be 5% per annum, and it will be forever after that. And we are assuming 10% rate of return. So how we'll solve the problem? So in this case, we'll use this formula. So PO is the price of the share, or the current market price of the share. DT is the expected dividend per share at period T, which will be DT here, divided by 1 plus R power T, plus Pn. Pn is the expected terminal value at the end of period N, or the constant growth formula. As we know that first 3 years the company will have super growth rate, which is 20% per annum. So what is the price of the share after 3 years, and when it will have super growth rate? And R is the interest rate, but R is the interest rate, or the required rate of return. If we put the solution, first of all, we put all 4 years, so year 1, 2, 3, and 4. Expected dividend year 1 is 18 cents, year 2 is 0.216 cents, and year 3 is 0.259 cents, and year 4 is 0.272 cents. Now if you look into the dividend, if you do the calculation, which is dividend for year 0 was 15 cents, multiply 1 plus G, so it will be 18 cents. So how we're going to do that? So if we put it this way, so if I show it to you here, so it will be 0.15 multiply 1 plus 0.2, which is the growth rate. We close the bracket. So it will look like that. So D1 is 18 cent. How we calculated it? It's 15 cent. Just I need to put here. So if you look here, that the expected dividend would be 0.18 cent. So initial dividend was 0.15 multiplied by 1 plus 0.02, which is the growth rate. So first 3 years we have super growth rate, so this will be the dividend. So this is D1, D2 and D3, and after year 3, as we know, the dividend will grow at the rate of 5% per annum. So the growth rate, so we'll use the same formula, but instead of 0.2 here, we'll use 0.05. So D4 will be 0.272. So first of all, we need to calculate what is the P3. Now the P3 was showed in here is we need it for the PN. PN is expected terminal value at the end of period N. So that's why we need the PN. So P3 would be D4, which is 0.02072 divided by R minus G. So we calculate is 5.44 if we solve the problem, we solve the equation. So if we put all things together, so the solution will be price of the share which is having non-constant growth rate, D1, D2, D3 and P3, 1 plus R power 1, 1 plus R power 2, 1 plus R power 3 and 1 plus R power 3 again. The reason behind it, we still put power 3 here because this is end of 3 years. Because we're trying to get the terminal value P3 or PN, so which is 5.44, which we get it from here. So if you go back one slide, you'll find that the value 5.44 is included there. So it is 5.44. So if we add the value, as we know, the growth rate is growth rate will be, as we know, the record rate of return is 10%. So we put the 10% and we solve the equation. You will find the value of the share will be 4.63%. Hopefully this calculation will clear any of your confusion about the dividend discount model. If you want to do using the calculator, the financial calculator, now we recommend in this class to use Sharp ELS735 as calculator. If you use that calculator, you can find the same answer using this formula. So 0 ENT, and then we're putting all the dividends. So you could use this and then you'll find the same answer. So I would ask the student to use the calculator, try and press the buttons and try to find out the same answer. And you'll find that when you're using the formula, we're getting 4.63. When we're using the calculator, we're getting 4.62, so which is almost the same answer. Now, as we understand how to calculate the ordinary equity and the preference share. Now, in the share market, whenever an investor will invest in the market, they will face different types of risk. Now, one of the biggest risks they will face is called systematic risk. Now, the systematic risk which affect the entire market, and it cannot be diversified away. For example, the interest rate risk, changes in the legislation. These are the examples of the systematic risk. On the other hand, there are other types of risk called the unsystematic risk or firm-specific risk. So this risk is not for the whole market, but it is for an individual security. However, how to reduce this risk? The investors use diversification to or diversify their portfolio in order to reduce the unsystematic risk. So when we're talking about the total risk includes the systematic risk and unsystematic risk. So if you look at this graph, in this graph showing in here is the standard deviation of the portfolio return, which is this part. Now we can also talk about this is the total risk, because as in the previous slide we have seen the total risk includes systematic portion of the risk and unsystematic portion of the risk. So this is the systematic risk, which is a flat line we can see here, because as we know this is a market risk and it cannot be avoidable, so it remains the same. So this is systematic risk. On the other hand, this part, which is actually reducing slowly, what you can see is unsystematic risk. But why it is reducing? If you look at the number of securities in this portfolio, so the more number of securities included in this portfolio, the unsystematic risk is reduced. Now it is in the textbook, most of the textbooks suggest that using around 20 to 30 shares in a well diversified portfolio will reduce the unsystematic risk significantly. However, this is to note that we cannot eliminate unsystematic risk. We can reduce it using a well diversified portfolio. Managing the systematic risk. The systematic risk is measured by the beta. The beta measures the extent to which a share's return are related to the variability of the entire market. So if you look into the beta of a share, if the beta is more than 1, you'll find that the systematic risk is higher than the overall market. In a market, the systematic risk will be about 1. So if the beta is greater than 1, it means this particular security having a higher systematic risk than the overall market. If the beta is less than 1, it means this particular security has lower systematic risk than the overall market. So next slide is the share market indices. Now, as the stock exchange are listed to the stock exchange, and we can see in the share market, for example, S&P 500, ASX Top 200, you can see the share market indices. But what does it mean? How these indexes are calculated? So this slide will give you some idea how these indices are calculated. Now, in the market, we can see two different types of indices. One is the price weighted indices, or the price weighted index. Now, how it has been calculated? So the price weighted index calculated based on the sum the price of individual shares comparison in an index. Then the sum is divided by a deviator to choose the base index value. As the share price change, the deviators remain constant. For example, if in a stock exchange there are 100 companies are listed, so using the price weighted index, it will calculate the price of each individual share multiply by the number, so each price of each individual shares and then the price of each individual share, add them all, and then divided by the number of shares or number of observed shares, which is 100. On the other hand, market value weighted index is another type of index which is quite common. So the value weighted index is computed as the following. One, it computes the total market value of a firm in the index and the value of the firm on the previous trading day. So it includes all the value of the firms, all included firm's value of the firm in the index in the previous trading day, and then the percentage change from one day to the next represents the changes of the index. So it looks at the price changes over the time from one trading day to another trading day. So now that is called the value weighted index. Now the share market and economic activity are closely correlated. If economy is not doing very well, it will impact the share market. The same way, if the share market is not doing well, it will impact the overall economy. So there is an interrelationship between the economy and the share market. There are several research which found that the economic activity are impacted by the share market, and there is a positive correlation among them. Okay, so we learn about the stock market. We learn about how to value the shares, how to value the preference share. What are the factors which are important to consider during the investment on the stock exchange? However, how to buy a share, this is also important. So we'll look to a video, the video by the Warren Buffett, how to invest in stock market, and I believe this video will give you a clear idea about how to invest in the share market. Hopefully you'll enjoy the video. Thank you.
I never know what markets are going to do. I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt it was important. We're almost always a buyer of stocks, and we're a more aggressive buyer when they're going down. I mean, I feel much better when they're going down. I think every business should be run as efficiently as possible. And some are and some aren't. We try to buy the ones that are. I mean, I bought my first stock in April of 1942. I was 11. Pearl Harbor had happened 3 or 4 months earlier. We were losing the war. I mean, if you want to talk about a bad outlook for the country's not going to go away. The plants aren't going to go away. The people aren't going to go away. The talents aren't going to go away. The country will grow in value over